Welcome back to the Daily Crypto Roundup. We are going to cover 5 major stories today. Bitcoin breaking above $73,000, while traders warn of a potential bull trap. Institutional investors pouring $1.7 billion into spot Bitcoin ETFs. A major Federal Reserve signal, suggesting interest rate cuts may be coming. A surprising $50 million investment from Tether into a sleep technology company that shows how crypto profits are spreading into the wider tech world. And finally, a political moment in Washington that could shape the future of crypto regulation after Coinbase CEO Brian Armstrong met with President Donald Trump just hours before Trump publicly attacked banks over a major crypto bill. But before we dive into those stories, let's start with where the market actually stands right now. Traditional markets have been dealing with geopolitical uncertainty, shifting interest rate expectations, and renewed volatility in energy prices. Yet crypto, which historically has behaved like a high-risk asset that sells off aggressively during global uncertainty, has instead held firm, and in some cases even rallied. That contrast is one of the most interesting themes developing in this cycle, and it leads us directly into our first major story. Bitcoin has broken above $73,000, but not everyone is celebrating the move. A growing number of traders are warning that this breakout could actually be a bull trap. In market terminology, a bull trap occurs when an asset appears to break above resistance, attracting new buyers, only for the price to reverse sharply and trap those late entrants in losing positions. It's something that has happened repeatedly throughout crypto history, and many analysts are cautious because the recent structure of the Bitcoin market still shows signs of fragility. Part of that caution comes from the memory of what happened earlier this year when Bitcoin surged toward the $98,000 region, before collapsing back toward $60,000 within just a couple of weeks. That move shook confidence among leveraged traders and left a large number of participants wary of chasing breakouts too aggressively. Analysts who track derivatives markets are watching funding rates and open interest levels very closely right now because those indicators often reveal whether a rally is being driven by genuine spot demand or by short-term speculative leverage. If funding rates become excessively positive, it usually means traders are piling into long positions with borrowed money, which can create the conditions for sharp liquidations if the price turns downward. On the other hand, if a rally forces large numbers of short sellers to close their positions, that can create a short squeeze where automated buying pressure accelerates the move higher. That dynamic has already started to appear over the past 24 hours as Bitcoin pushed through key resistance levels and triggered liquidations across the derivatives market. But there's another side to this story that is much more bullish, and it comes from institutional investors. According to new data from the spot Bitcoin ETF market, investors poured approximately $1.7 billion into Bitcoin ETFs during the recent dip. That number is significant because these funds represent one of the primary ways large institutions gain exposure to Bitcoin without holding the asset directly. The ETFs essentially act as a bridge between traditional finance and the crypto ecosystem, allowing pension funds, asset managers, and institutional portfolios to allocate capital into Bitcoin through familiar financial instruments. When inflows of this magnitude occur during periods of market uncertainty, it sends a very strong signal about what sophisticated investors are actually doing behind the scenes. Retail traders might be debating whether the latest breakout is a bull trap, but institutional capital appears to be accumulating Bitcoin during periods of weakness. Historically, that behavior has often preceded major upward moves in the market, because institutional buying tends to absorb supply over time, rather than chasing short-term price spikes. It's also worth remembering that ETF inflows do not always translate into immediate price movements. The mechanics of how ETFs acquire their underlying assets can involve arbitrage desks and market makers who hedge positions through futures markets before the actual Bitcoin purchases are executed. That means a large inflow today might not produce visible buying pressure until later, as those hedging positions are unwound. For long-term investors, however, the trend in ETF flows is often more important than the immediate reaction in price. While institutional money appears to be buying the dip, the macroeconomic environment is also shifting in ways that could support crypto markets. A senior Federal Reserve official has recently reiterated support for interest rate cuts, and those comments have helped drive a broader rally across risk assets, including cryptocurrencies. Interest rates are one of the most powerful forces shaping global financial markets. When rates are high, investors tend to prefer safer assets such as government bonds that offer predictable returns. When rates fall, however, liquidity increases across the system, and capital begins flowing toward assets that offer higher potential returns, including technology stocks, venture capital, and cryptocurrencies. For the crypto market, the prospect of lower interest rates is particularly important, because previous bull runs have often coincided with periods of monetary easing. Lower rates make borrowing cheaper, increase the availability of liquidity in financial markets, and encourage investors to allocate capital toward emerging technologies and alternative assets. Even the hint that the Federal Reserve might move toward rate cuts is often enough to trigger renewed optimism among traders who view crypto as one of the most responsive asset classes to shifts in global liquidity. The latest comments from the Federal Reserve have therefore added another layer of momentum to the current rally. When you combine that macro tailwind with the evidence of institutional accumulation through ETF inflows, it becomes easier to understand why Bitcoin has been able to recover so quickly, despite geopolitical tensions and volatility in traditional markets. But the story of crypto's expanding influence doesn't stop with price movements or macroeconomics. Another headline this week reveals how profits generated within the crypto industry are beginning to flow into entirely different sectors of the technology economy. Tether, the company behind the world's largest stablecoin, has invested $50 million in a sleep technology startup called 8Sleep. At first glance, that might sound like an unusual move for a company associated primarily with digital dollars and blockchain infrastructure. However, when you examine the broader strategy, it begins to make much more sense. Tether has become one of the most profitable companies in the entire crypto ecosystem because of the way its stablecoin reserves are structured. The company holds billions of dollars in assets, including U.S. Treasury bills that generate substantial interest income. Those profits have given Tether a war chest that it has increasingly been deploying into venture investments across multiple industries. The investment in 8Sleep is part of a broader trend where crypto companies are evolving beyond their original roles as infrastructure providers and are instead becoming global technology investors. 8Sleep develops advanced mattresses and sleep systems equipped with sensors that track biometric data such as heart rate, breathing patterns, and body temperature. The company uses artificial intelligence to analyze that data and adjust sleep environments in real time, helping users optimize rest and recovery. For Tether, the connection lies in the intersection of artificial intelligence, hardware technology, and privacy-focused data processing. The company has been building an internal platform designed to process sensitive data directly on devices, rather than sending it to centralized cloud servers. By investing in companies that operate at the intersection of health technology and artificial intelligence, Tether is effectively positioning itself within one of the fastest-growing sectors of the global tech economy. This strategy highlights an important shift in how crypto capital is being deployed. Instead of remaining confined within blockchain projects, profits generated by crypto infrastructure are increasingly being reinvested into broader technological innovation. In some ways, this mirrors the early days of Silicon Valley, where successful software companies began funding entirely new industries through venture investments. The final story today brings us to Washington and the growing political influence of the crypto industry. Coinbase's Brian Armstrong recently met with President Donald Trump at the White House, and shortly after that meeting, Trump publicly criticized banks for opposing a major piece of crypto legislation currently moving through Congress. The bill at the center of the dispute aims to create clearer regulatory guidelines for digital assets, defining which cryptocurrencies should be treated as securities and which fall under commodity regulation. For years, the lack of regulatory clarity in the United States has been one of the biggest obstacles facing the crypto industry. Companies have often struggled to determine which rules apply to their products and which regulators have jurisdiction over different aspects of the market. The proposed legislation attempts to resolve that uncertainty by establishing a clearer framework that would divide oversight between the Securities and Exchange Commission and the Commodity Futures Trading Commission. However, traditional banks have reportedly been pushing back against parts of the bill, particularly provisions that could allow crypto platforms to offer interest-like rewards on stablecoins. Banks argue that such products could attract deposits away from traditional financial institutions, potentially weakening the stability of the banking system. Crypto companies, on the other hand, claim that banks are simply trying to protect their monopoly over savings products and prevent new competitors from entering the market. Trump's public comments following the meeting with Armstrong suggest that the political landscape may be shifting. By criticizing banks for obstructing the legislation, the White House appears to be signaling support for the crypto industry's push toward regulatory clarity. Markets reacted quickly to that development, interpreting it as a sign that the United States may move closer to establishing a comprehensive framework for digital assets. When you step back and look at the bigger picture, today's headlines reveal a fascinating convergence of forces shaping the future of crypto. Institutional investors are accumulating Bitcoin through ETFs, while retail traders debate whether the latest breakout is sustainable. Federal Reserve officials are hinting at monetary easing that could inject additional liquidity into global markets. Crypto companies are deploying billions of dollars into technology investments far beyond the blockchain sector. And political leaders in Washington are increasingly engaging directly with industry executives as regulatory frameworks begin to take shape. Taken together, these developments suggest that crypto is entering a new phase of maturity. The market is no longer driven purely by speculative enthusiasm or isolated technological breakthroughs. Instead, it is becoming deeply intertwined with global macroeconomics, institutional finance, venture capital, and political decision-making. That transformation is exactly what many early advocates of Bitcoin envisioned more than a decade ago. They believed that digital assets could eventually become an integral part of the global financial system rather than a niche experiment on the fringes of the internet. While there are still many challenges ahead, the events of the past 24 hours provide a clear reminder that crypto has already traveled a long way along that path. And the next phase could be even more dramatic. If institutional inflows continue, if interest rates begin to fall, and if regulatory clarity emerges in major economies, the conditions for the next major expansion of the crypto market could already be forming beneath the surface. So keep an eye on those ETF flows, watch the signals coming out of the Federal Reserve, and pay attention to the political developments unfolding in Washington, because the combination of those factors may ultimately determine where Bitcoin and the broader crypto market head next. Drop your thoughts in the comments, smash like, follow the show, and we will see you at the top.